Okay, CFA Level 1 Program Curriculum students, welcome back to Reading 24, Understanding Balance Sheets. So we are now understanding balance sheets, the learning outcomes that a candidate should be able to describe the elements of balance sheets, asset, liabilities, and equity, describe uses and limitations of the balance sheet in financial analysis, describe alternative formats of balance sheet presentation, distinguish between current and non-current assets and current and non-current liabilities, describe different types of assets and liabilities and the measurement bases of each, describe the components of shareholders' equity, cover balance sheets to common size balance sheets and interpret common size balance sheets, calculate and interpret liquidity and solvency ratios. Introduction. The balance sheet provides information on a company's resources, assets, and its sources of capital or equity and liability/debt. This information helps an analyst assess a company's ability to pay for its near-term operating needs, meet future debt obligations, and make distributions to owners. The basic equation underlying the balance sheet is assets equals liabilities plus equity. Analysts should be aware that different items of assets and liabilities may be measured differently. For example, some items are measured at historical cost or a variation of thereof, and others at fair value. An understanding of measurements issued will facilitate analysis. The balance sheet measures issues are, of course, closely linked to the revenue and expenses recognition. Issues affecting the income statement. Throughout this reading, we describe and illustrate some of the linkages between the measurement issues affecting the balance sheet and the revenue and expense recognition issues affecting the income statement. This reading is organized as follows. Section 1, we describe and give examples of the elements and formats of balance sheets. Section 3 discusses current assets and current liabilities. Section 4 focuses on assets. And Section 5 focuses on liabilities. Section 6 describes the components of equity and illustrates the statement of change in shareholders' equity. Section 7 introduces balance sheet analysis. A summary of the key points and practice problems. The CFA Institute multiple choice format concludes the reading. Components and format of the balance sheet. The balance sheet, also called the statement of financial position statement or statement of financial condition, describes what the entity owns or controls and what it owes and what the owners claim at a specific point in time. The financial positions of a company is described in terms of basic elements, assets, liabilities, and equities. Assets, liabilities, and equities. The equation A equals L plus E is sometimes summarized as follows. The left side of the equation reflects the resources controlled by the company, and the right side reflects how the resources were financed. For all financial statement items, an item should be only recognized in the financial statement if it is probable that any future economic benefit associated with the item will flow to or from the entity, and if the item has a cost or value that can be measured with reliability. The balance sheet provides important information about a company's financial conditions, but the balance sheet amount is equal, should not be viewed as the measures of either the market or intrinsic value of the company's equity for several reasons. First, the balance sheet under current account standards is a mixed model with respect to measurements. Some assets and liabilities are measured based on historical cost, sometimes with adjustments, whereas other assets and liabilities are measured based on current value. The measurement bases may have a significant effect on the amount reported. Second, even the items measured at current value reflect the value that was current at the end of the reporting period, the values of those items obviously can change after the balance sheet is prepared. Third, the value of a company is a function of many factors, including future cash flows expected to be generated by the company and current market conditions. Important aspects of the company's ability to generate future cash flow, for example, is its reputation and management skills that is not included in the balance sheet. The balance sheet component it illustrates the components and formats of the balance sheet. We show the major subtotal of the companies in the balance sheet. Exhibit 1 and Exhibit 2 are based on the balance sheet of SAP Group and Apple Incorporated. SAP Group leads the business software company based in Germany and prepares financial statements in accordance to the IFRS. Apple Technology Manufacturers based in the United States and prepares its financial statements in accordance with the US GAAP. For purposes of discussion, Exhibit 1 and 2 only shows main subtotals and total of the company's balance sheets. Additional exhibits throughout this reading will expand on these subtotals. SAP Group uses the title statement of financial positions consistent with IFRS, and Apple uses the title balance sheet. Despite the different titles, both statements report on three basic statements or three different elements: asset, liabilities, and equity. Both companies are reporting on a consolidated basis, i.e. including all their controlled subsidiaries. The number of SAP Group balance sheets are in the millions of euros, and the number of balance sheets, Apple's balance sheets, are in the millions of dollars. More like the billions of trillions of dollars. Apple's the first $1 trillion company. Anyways, balance sheet information is as of a specific point in time. These exhibits are from the company's annual financial statements, so the balance sheet information is as the last day of their respective fiscal year. SAP Group's fiscal year is the same as the calendar year, and the balance sheet information is as of 31st of December. Apple's fiscal year end on the last Saturday of September, so the actual date changes from year to year. About every 6 years, Apple's fiscal year will include 53 weeks rather than 52 weeks. This feature of Apple's fiscal year should be noted, but in general, the actual week is more relevant in evaluating statements spanning a period of time rather than the balance sheet, which captures information as of a specific point in time. A company's ability to pay for its short-term operating needs relates to the concept of liquidity. With respect to a company, overall liquidity refers to the availability of cash to meet those short-term needs. With respect to a particular asset or liability, liquidity refers to its nearness to cash. A liquid asset is one that can be easily converted into cash in a short-term period of time at a price close to fair market value. For example, a small holding of an activity traded stock is much more liquid than an asset such as a commercial real estate property in a weak property market. The separate presentation of current and non-current assets and liabilities enables an analyst to examine the liquidity positions. Both IFRS and US GAAP requires that the balance sheet distinguishes between current and non-current assets and between current and non-current liabilities and presents these as separate classifications. An exception of these requirements under IFRS is the current and non-current classification are not required if the liquidity-based presentation provides reliable and more relevant information. Presentation distinguishing between current and non-current elements are shown in Exhibit 1 and 2. Exhibit 3 in Section 2.3 shows a liquidity-based presentation. Current and non-current classification: assets held primarily for the purposes of trading or expected to be sold, used up, or otherwise realized in cash within 1 year or one operating cycle of the business, whichever is greater after the reporting period, are classified as current accounts. Or current assets. A company's operating cycle is the average amount of time that elapses between acquiring inventory and collecting the cash from sales to customers. For a manufacturer, this is the average amount of time between acquiring raw materials and converting these into cash for a sale. Examples of companies that might be expected to have operating cycles longer than 1 year are those on the tobacco, distillery, and lumber industry. Even though these types of companies often hold inventories longer than 1 year, the inventory is classified as current assets because it is expected to be sold within the operating cycle. Assets are not expected to be sold or used within 1 year or one operating cycle of the business, whichever is greater, are classified as non-current assets or long-term, long-lived assets. Current assets are generally maintained for operating purposes, and these assets include, in addition to cash, items expected to be converted into cash, used up or sold in the current period. Current asset provides information about the operating activities and the operating compatibility of the entity. For example, the item trade receivables or account receivables will indicate that a company provides credit to its customers. Non-current assets represents the infrastructure from which the entity operates and are not consumed or sold in the current period. Investments is such in such as assets as made from strategic or longer term perspectives. Similarly, liabilities expected to be settled within 1 year or within one operating cycle, whichever is greater, after the reporting period, are classified as current liabilities. The specific criteria for classification of liabilities and current accounts are as follows. IFRS specified that some current liabilities, such as trade payables and some accruals for employees and other operating costs as part of the working capital used in the entity's normal operating cycle, such operating items are classified as current liabilities, even if they will be settled more than 1 year after balance sheet date. When the entity's normal operating cycle is not clearly identified, its duration is assumed to be 1 year. All other liabilities are classified as non-current liabilities. Non-current liabilities includes financial liabilities and provide financing on a long-term basis. The excess of current assets over current liabilities is called the working capital. The level of working capital tells analysts something about the ability of the entity to meet liabilities as they fall due. Although adequate working capital is essential, working capital should not be too large because funds may be tied up that could be used more productively elsewhere. A balance sheet with separately classified current and non-current assets and liabilities is referred to as classified balance sheet. Classification also refers generally to the grouping of accounts into subcategories. Both companies' balance sheets that are summarized in Exhibit 1 and 2 are classified balance sheets. Although both companies' balance sheets present current assets before current assets and current liabilities before non-current liabilities, this is not required. IFRS does not specify the order or format in which a company presents items on a current/non-current classified balance sheet. Liquidity-based presentation. A liquidity-based presentation, rather than a current/non-current presentation, is used when such a presentation provides information that is reliable and more relevant. With a liquidity-based presentation, all assets and liabilities are presented broadly in order of liquidity. Entities such as banks are candidates to use a liquidity-based presentation. Exhibit 3 presents the assets portion of the balance sheets of China Construction Bank, a commercial bank based in Beijing that reports using IFRS. The Hong Kong Stock Exchange and Bank's A shares are listed in the Shanghai Stock Exchange. Its balance sheet, in order to use a liquidity-based presentation, as shown in the assets section, begin with cash and deposits with central banks, less liquidity items such as fixed assets and land use rights appears near the bottom of the asset list. Current assets and current liabilities. Okay, current assets. Accounting standards require that certain specific line items, if they are material, must be shown on a balance sheet. Among the current assets required line items are cash and cash equivalents. Trade and other receivable inventories are financial assets. Companies present other line items as needed, consistent with the requirements to separately present each material class of the similar items. As example, Exhibit 4 and Exhibit 5 present balance sheet experts for SAP Group and Apple Incorporated, showing the lines items of the company's current assets. Cash on cash equivalent. Cash equivalents are highly liquid short-term investments that are so-called to maturity. The risk is minimal that the value will change significantly, will change the interest rates. Cash on cash equivalent are financial assets. Financial assets in general are measured and reported either in amortized cash or fair value. Amortized cash is the historical cost of asset adjusted for amortization of impairment. Under IFRS or the US GAAP, fair value is based on exit price, the price received to sell an asset or pay to transfer the liability. in an ordinary transaction between two market participants in the measurement date. For cash and cash equivalents, amortized costs and fair value are likely to be immaterially different. Examples of cash equivalents are demand deposits with banks and highly liquid investments such as U.S. Treasury bills, commercial paper, and money market funds. With original maturities of 3 months or less, cash and cash equivalents excludes amounts that are restricted if used for at least 12 months. For all companies, the statement of cash flow presents information about changes in cash over a period. For the fiscal year of 2009, SAP Group's cash and cash equivalents increased from 1,280 to 1,844, and Apple's cash and cash equivalents decreased from such to such. Marketable securities. Marketable securities are also financial assets and includes investments in debt or equity securities that are traded in a public market, and whose value can be determined from price information in the public market. Examples of marketable securities include treasury bills, notes, bonds, and equity securities, such as common stocks and mutual fund shares. Companies disclose further detail in the notes to their financial statements about their holdings. For example, SAP Group discloses their financial assets consist mainly of time deposits, investments in insurance policies, and loans to employees. Apple's short-term marketable securities totaling $18.2 billion and 10.2 billion at the end of fiscal year 2009 and 2008 respectively consists of fixed income securities with a maturity of less than 1 year. Financial assets such as investments in debt and equity securities involve a variety of measurements issues with the address in section 4.5. Trade receivables. Trade receivables, also referred to as accounts receivables, are another type of financial assets. This type amounts owns to a company by its customers and for products and services already delivered. They are typically reported as net revisable value, an approximation of fair value based on estimates of collectability. Several aspects of accounts receivables are usually relevant to an analyst. First, the overall level of account receivables relative to sales is important because a significant increase in account receivables relative to sales can signal the company is having problems collecting cash from its customers. A second relevant aspect of account receivables is that of the allowance of doubtful accounts. The allowance of doubtful accounts reflects the company's estimates and amounts that will ultimately be collectible, in addition to the allowance in the particular period and reflected as bad debt expenses. And the balance of the allowance for doubtful account reduces the gross receivable amount for the net amount that is an estimate of fair value. When specific receivables are deemed to be uncollectible, they are written off by reducing account receivables and allowance for doubtful accounts. The allowance for doubtful accounts is called contra accounts because it is netted against the balance of account receivables. When an asset account, the SAP Group's balance sheet, for example, reports current net what unicorns? September 2009 allowance, yeah. Okay. Inventories are the physical product that will eventually be sold to the company's customers, either in the current form, which is a finished good, or as an import into the process of manufacturing a final product. Likely any manufacturer, Apple holds inventories. The 2009 balance sheet of Apple Incorporated shows 455 million of the inventories. $455 million of inventories. S&P Group's balance sheet does not include a line for inventory, but its notes disclosures indicates that the inventory is inclined as a part of the non-financial assets in its balance sheet. SAP Group is primarily a software and service providing, and the amount of inventory is not material enough to require disclosure as a separate line on the balance sheet. Inventories are measured at the lower of the cost of realizable value under IFRS, and dependable amount inventory amount method under US GAAP. The cost of inventory compromises all costs of the purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. The following amounts are excluded from determining the inventory cost: abnormal amounts of wasted material, labor or overheads, storage costs, unless necessary prior to further production process, administrative overheads, and selling costs. The following techniques can be used to measure the cost of inventories if the resulting valuation amount approximates cost. Standard cost, which should take into account the normal level of material, labor, and actual capital. The standard cost should be reviewed regularly to ensure that the approximate actual cost. The retail method, in which the sales value is reduced by the gross margins to calculate cost. An average gross margin percentage should be used for each homogeneous product of items. In addition, the impact of marked down prices should be taken into consideration. Net revisable value, NRV, is the measure used by the IFRS, is the estimate's selling price less than estimated costs for competition and costs necessary to make the sale. Under US GAAP, inventories were measured at the lower of the cost or market value. Market value is current replacement cost, but with upper and lower limits, it cannot exceed NRV and cannot be lower than NRV, less than normal marginal profit or profit margin. Under US GAAP, inventories measured using other than last and first the retail inventory. If the net receivable realizable value or market value under US GAAP of the company's inventory falls below the carrying amount, the company must write down the value of the inventory. The loss and value is reflected in the income statement. For example, within management decisions and analysts and notes, Apple indicates that the company reviews its inventory each quarter and records write-downs of inventory that has been absolute, exceeds anticipated demand, or is carried out at a value higher than its market value. Under IFRS, if the inventory was written down in a previous period, subsequently increases in value, the amount of the original written down is reversed. Subsequent reversals of inventory write-downs is not permitted under US GAAP. If inventory is sold, the cost of the inventory is reported as an expense. Cost of a goods sold. Accounting standards allow different valuation methods for determining the amount of that are included in the cost of the goods sold on the income statement, and thus the amounts that are reported in the inventory and the balance sheet. IFRS allows only first in, first out, FIFO, weighted average cost as specific identification methods. Some accounting standards also allow last in, first out, in the additional inventory valuation method. The LIFO method is not allowed under IFRS. Other current assets. The amount shown in other current assets reflects that are individually not material enough to require a separate line item on the balance sheet. And so the aggregate into a single amount. Companies usually disclose the components in a list in a note to the financial statement. A typical item included in other current assets is prepaid expenses. Prepaid expenses are normal operating expense that have been paid in advance because expenses are recognized when the period in which they are incurred are necessarily the period in which the payments are made. The advance payments of a future expense creates an asset. The asset or prepaid expense will be recognized as an expense in future periods as it is used up. For example, consider prepaid insurance. Assume a company pays its insurance premiums to cover over the next calendar year on 31st of December of the current year. At the time of the payment, the company recognizes an asset, prepaid insurance expense. The expense is not incurred at the date. The expense is incurred as time passes. In this example, 1/12 is in each following month. Therefore, the expense is recognized and the value of the asset is reduced in the financial statement over the course of the year. Portions of the amount shown as the tax asset of the SAP's balance sheet and deferred tax assets on the Apple's balance sheet represents income taxes incurred prior to the time that the income tax expense will be recognized. On the income statement, deferred tax assets may result when the actual income tax payables based on income for tax purposes in a period exceeds the amount of income tax expense based on the reported financial statement incomes due to temporary timing differences. For example, a company may be required to report certain income for tax purposes if the current period, but to defer recognition of the income for financial statement purposes to subsequent periods. In this case, the company will pay income tax required by tax law, and the differences between the tax payables and the tax expense related to the income of which recognition was deferred on the financial statements will be reported as a deferred tax asset. When the income is subsequently recognized on the income statement, the related tax expense is also recognized, which will reduce the deferred tax asset. Also, a company may claim certain expenses for financial statement purposes that is only allowed to claim in subsequent periods for tax purposes. In this case, as in the previous example, the financial statement income before taxes is less than the taxable income. Thus, income tax payables based on taxable income exceeds income tax expenses based on accounting net income before taxes. The difference is expected to reverse in the future when the income reported in the future asset exceeds the taxable income as a deduction of the expense becomes allowed in tax for tax purposes. Deferred tax assets may also result from carrying forward unused tax losses and credits. Deferred tax assets are only to be recognized if there is an exception that there would be taxable income in the future, again, which the temporary difference or carried forward tax loss or credit can be applied to reduce tax payables. 3.2 Current liabilities. Current liabilities are those liabilities that are expected to be settled in the entity's normal operating cycles, held primarily for trading. Or due to be settled within Non-current assets. This section provides an overview of assets other than current assets, sometimes collectively referred to as non-current assets, long-term or long-lived assets. The category discussed are property, plants, and equipment, investment property, intangible assets, goodwill, and financial assets. Example 8 and example 9 presents balance sheet excerpts for SAP Group and Apple Incorporated, showing the line items of the company's non-current assets. Property, plants, and equipment. Property, plants, and equipment, or PPE, are tangible assets that are used in a company. Examples of tangible assets treated as property, plants, and equipment include land, buildings, equipment, machinery, furniture, and natural resources such as minerals and petroleum resources. IFRS permits companies to report PPE using either a cost model or a revelation model. While IFRS permits companies to use the cost model for some classes of assets and the valuation model for others, the company must apply the same method model to all assets within the particular class of assets. USGAAP permits only the cost model of the reporting PPE. Under the cost model, PPE is carried at amortized costs or historical costs less any accumulated depreciation or whereas depreciation is a systematically allocation of costs over the asset's useful life. Impairment losses reflect an unanticipated decline in value. Impairment occurs when the asset coverable amount is less than its carried amount, with terms defined as following under IFRS. Investment property. Some property is not used in the production of goods or services or for administrative purposes. Instead, they are used to earn rental income or capital appreciation or both. Under IFRS, the property is considered to be an investment property. USGAAP does not include a specific definition of investment property. IFRS provides companies with the choice to report investment properties using either a cost model or a fair value model. In general, a company must apply to its chosen model to all its investment property. The cost model for investment property is identical to the cost model of the PPE. In other words, investment property is carried at cost less any accumulated depreciation of any accumulated impairment losses. Under the fair value model, investment property is carried at its fair value. When a company uses the fair value model to measure the value of its investment property, any given or loss arises from a change in the fair value of the investment property is recognized in profit and loss, i.e. on the income statement. The period at which it arises, neither SAP Group nor Apple discloses ownership of investment property. The type of companies are typically to hold investment property are real estate investment companies and property management companies. Entities such as life insurance companies and endowment funds may also hold investment properties as part of their investment portfolio. Intangible assets. Intangible assets are an identifiable non-monetary assets without physical substance. An identifiable asset can be acquired singly, or is a result of specific contracted or legal rights to privilege. Examples include patent licenses and trademarks. Goodwill, which arises in business combinations and discusses further in section 4.4. IFRS allows companies to report intangible assets either as a cost model or as a revaluation model. The revaluation model could be selected when there is an active market for an intangible asset. The measurement amount model are essentially the same as described in the PPE. USGAAP implements only the cost model. For intangible assets, a company assesses whether the useful life of the asset is finite or indefinite. Amortization of impairments principles allows the follows. An intangible asset with the finite useful life is amortized in a systematic basis over the best estimate of its useful life, which is amortization method of the useful life estimates review at last annuity. Impairment principles for the intangible assets with a finite useful life of the same as the PPE. Intangible assets with the indefinite useful life is not amortized. Instead, at least annually, the responsible assuming an indefinite useful life for the asset is reviewed, and the asset is tested for impairment. Okay. Goodwill, that's the reputation and the name of the company, basically. Financial assets, that's quite a word. In the case of marketable securities classified as either the trading available for sales, the investments are listed under practically, the investments will be listed at the fair value of such an amount on one line within assets. In the case of trading securities, the unrealized gains is included when on the income statement and thus reflected in retained earnings within owner's equity. In the case of available for sale securities, the unrealized gain is not included on the income statement as profit or loss. Rather, it is treated as part of other comprehensive income and thus reflected in the accumulated other comprehensive income within owner's equity. Other comprehensive income includes gains and losses that have not been reported on the income statement due to particular account standards. As noted previously, under IFRS 9, the available for sale method no longer applies as the unrealized gains is unrecognized in the income statement. In the case of a hold-to-maturity securities, the security is measured at cost rather than a fair value. Therefore, no unrealized gains is reflected as either the balance sheet nor income statement, nor through comprehensive income. In Exhibit 4 and 8, SAP Group's 2009 balance sheet shows other financial assets of 486 million current and 284 non-current. The company's note discloses that most of the financial assets and loans are receivables, 422 million current and 168 million non-current. Also, 87 million of the non-current other financial assets are classified as available for sale equity investments, of which 62 million are venture capital investments without quoted market prices. The notes disclose that fair value cannot be estimated by referencing the to quote market prices or by discounted estimates of future cash flows, and such investments are accounted for by the cost approximating fair value, with impairment being assessed. In Exhibit 5 and 9, Apple's 2009 balance is shown to be 201 million for the short-term marketable securities, and such amount 47.5 billion in total assets. Marketable securities plus cash and cash equivalents represent around 62% of the company's total assets. Apple's notes disclose that most of the company's marketable securities are fixed income securities issued by the U.S. government or its agencies, and by other companies, including commercial papers. In accordance with its investment policy, Apple invests in highly rated securities. The company classifies its marketable securities as available for sale and reports them on the balance sheet as fair value. Unrealized gains and losses are reported in other comprehensive income. Okay, I'm going to pause my recording here. We're going to continue next time on reading 24. starting from non-current liabilities and then finishing on page 1557. So it's cool that we have passed the 1,500 mark, and so I do hope my readings of the CFA Level 1 program curriculum have been helpful, and reading 24 has been helpful for y'all, and I hope to see you guys soon. Okay, goodbye. Non-current liabilities. All liabilities that are not classified as current are considered to be non-current or long-term. Exhibit 12 and 13 present balance sheet experts for SAP Groups and Apple Incorporated, showing the line items of the companies and non-current liabilities. Both companies' balance sheets show non-current unearned revenue. The amounts represented the amounts of unearned revenue related to goods and services expected to be delivered in the period between 12 months following the reported period. The section that follows focuses on two common types of non-current liabilities: long-term financial liabilities and deferred tax liabilities. Long-term financial liabilities. Typical long-term financial liabilities include notes or loans and notes or bonds payable. Liabilities such as loans payable and bonds payable are usually reported to amortized costs on the balance sheet. At maturity, the amortized cost of the bond current amount will be equal to the face value of the bond. For example, if a company issues 100 million of bonds at par, the bonds are reported on as a long-term liability of 10 million. The carrying amount or amortized cost for the issue of maturity remains 100 million. As another example, if a company issues 100 million in bonds at a price of 97.5, a discount to par, the bonds are reported as a liability of 9,750,000 over the bond's life, and a discount of 250,000. The amortized, so it is amortized so that the bonds will be listed as the liability of 10 million at maturity. Similarly, any bond premium would be amortized for bonds issued at the price in excess with the face of the par value. In some cases, liabilities such as bonds issued by a company are reported at fair value. These cases include financial liabilities held for trading derivatives that are a liability to the company, and some non-derivative instruments such as those which are hedged by derivatives. SAP Group's balance sheet in Exhibit 12 shown 699 million of bank loans and 30 million of other financial liabilities. Apple's balance sheet does not show any non-current financial liabilities. Deferred tax liabilities. Deferred tax liabilities result from temporary timing differences between a company's income as reported for tax purposes and the income as reported for financial statement purposes. Deferred tax liabilities result when taxable income and the actual income tax payables in a period based on it is less than the reported financial statement income before taxes and the income tax expense based on it. Deferred tax liabilities are defined as the amount of income tax payable in a future period in respect of the taxable temporary differences. In the previous discussion of unrelated revenue, inclusion of revenue in taxable income in an earlier period created a deferred tax asset, or essentially a prepaid tax. Deferred tax liabilities typically arise when items of expense are included in taxable income in earlier periods than for financial statements net incomes. This results in a taxable income being less than an income before tax in the earlier period. As a result, taxes payable based on taxable income are less than income tax expense based on accounting income before taxes. The difference between taxes payables and income tax expense results in a deferred tax liability. For example, when companies use accelerated depreciation methods for tax purposes and straight line depreciation methods for financial statement purposes, deferred tax liabilities arise when items of income are included in taxable income in later periods. For example, when a company's subsidiary has profits that have not yet been distributed and thus have not yet been taxed. The SAP Group's balance sheet in Exhibit 12 shows 190 million of the deferred tax liabilities. Apple's balance sheet in Example 13 does not show a separate line item for deferred tax liabilities. However, note disclosures indicate that $3,502 million of non-current liabilities reported on Apple's balance sheet includes deferred tax liabilities of $2,216 million. Equity is the owner's residual claim on a company's asset after subtracting its liabilities. It represents a claim of the owner against the company. Equity includes funds directly invested in the company by the owner, as well as earnings that have been reinvested over time. Equity can also include items of gains or loss that are not yet recognized on the company's income statement. Component of equity: Six potential components comprise total owner's equity. The first 5 components listed below comprise equity attributable to owners of parents. The 6 components of equity attributable to non-controlling interests are capital controlled by owners, preferred shares, treasury shares, retained earnings, accumulated other comprehensive income, and non-controlling interest. Exhibit 14 and 15 present experts of the balance sheet of SAP Group and Apple Incorporated, respectively, with detailed lined items of each company. Equity section. SAP's balance sheet indicates that the company has 1,226 million shares of no par common stock outstanding, with a corresponding amount shown in issued capital of 1,226 million. Presentation of the amount of treasury shares, 1,320 million, is explained in the company's note. Treasury shares are recorded at acquisition cost and are presented as a deduction of the total equity. Gains and losses are on the subsequent reissuance of treasury shares are accredited or charged to share premium on an after-tax basis. Thus, the line item share premium of 370 million includes amounts of treasury share transactions. The amount of retained earnings of 8,571 million represents the cumulative amount of earnings that the company has recognized in its income statement, not the dividends. SAP Group's 370 million of other components of equity includes the company's accumulated other comprehensive income. The consolidated statement of changes in equity shows that this is composed of 319 million of losses on exchange differences in translation, 13 million gains on remeasuring available for sale financial assets, and 11 million losses on cash flow hedges. The balance sheet presents a subtotal of the amount of equity attributable to the parent company, 8,477 million, followed by the amount of equity attributable to non-controlling interests. Total equity includes both equity attributable to the parent company and the equity attributable to non-controlling interests. The equity section of Apple's balance sheet consists only three lines items: the common stock, the retained earnings, and accumulated other comprehensive income / loss. The company holds no treasury stock and has no minority interests. Statement of changing equity. The statement of changing equity, or the statement of shareholders' equity, presents information about the increase or decrease in a company's equity over a period. Total comprehensive income for the period, the effects of changing accounts in the previous periods, capital transactions with owners and distributors to owners, and reconciliation of the carrying amount of each component of equity at the beginning and end of the year. USGAAP, the requirements are specified by the SEC, is for companies to provide an analysis of charge in each component of stockholders' equity that is shown in the balance sheet. Exhibit 16 presents an expert from Apple's consolidation statement of changes in shareholders' equity. The expert shows only one of the years presented on the actual statement. It begins with a balance as of 27th of September 2008, and the presence of the analysis of changes of 26th of September 2009 in each component of equity that is shown in Apple's balance sheet. I'm just drinking water today. Plain old bottled water. Okay. As shown, the company issued was 11.48 million new shares in connection with its employee stock plans, increasing the number of shares outstanding from 888.326 million to 899 million. The dollar balance in common stock also increased in connection with stock-based compensation. Retained earnings increased from 8,235 million net income to 11 million adjusted in connection to the stock plans for companies that pay dividends. The amount of dividends as are shown separately as a deduction from retained earnings. Apple do not pay dividends. The statement also provides details on the 86 million changes in Apple's accumulated upper comprehensive income. Note that the statement provides a subtotal for total comprehensive income that includes net income and each of the components of other comprehensive income. Analysis of the balance sheet. This section describes two tools for analyzing the balance sheet: common size analysis and balance sheet ratios. Analysis of a company's balance sheet can provide insight into the company's liquidity and solvency as of the balance sheet date, as well as the economic resources the company controls. Liquidity refers to the company's ability to meet its short-term financial commitments. Assessments of liquidity focus a company's ability to convert assets to cash and to pay for operating needs. Solvency refers to a company's ability to meet financial obligations over the long term. Assessments of solvency focus on a company's financial structure and its ability to pay long-term financing obligations. Common size analysis of the balance sheet. The first technique, vertical common size analysis, involves stating each balance sheet item as a percentage of total assets. Common size statements are useful in comparing a company's balance sheet composition over time and across companies in the same industry. To illustrate, panel A of Exhibit 17 presents a balance sheet of three hypothetical companies: Company C with such and B and A as such. Most of the assets in Company A and B are current assets. However, Company A are nearly 60% of the total assets in cash and short-term marketable securities, while Company B has only 6% in its assets in cash. Company A is more liquid than Company B. Company A shows no current liabilities, and that the cash held on hand is 1 million to meet the near-term financial obligations it might have. In contrast, Company B has 2.5 million of current liabilities, which exceeds its available cash of only 200,000. To pay these near-term obligations, Company B will need to collect some of its accounts and receivables, sell more inventory, borrow from the bank, and or raise more long-term capital, e.g. by issuing more bonds or more equity. Company C also appears more liquid than Company B. It holds over 30% of its total assets in cash and short-term marketable securities. The current liabilities are only 6.2% of the amount of total assets. Company C's 3.3 million in cash and short-term marketable securities is substantially more than its current liabilities of 600,000. Turning a question of solvency, however, notes that 98.5% of Company C's assets are financed with liabilities. If Company C experiences significant fluctuations in cash flows, it may be unable to pay the interest and principal on its long-term bonds. Company A is far more solvent than Company C, with less than 1% of its assets financed with liabilities. Note that these examples are hypothetical only. Other than general comparisons, little more can be said without further detail. In practice, a wide range of factors affect a company's liquidity measurements and capital structure. The study of optimal capital structure is a fundamental issue addressed in corporate finance. Capital refers to a company's long-term debt and equity financing. Capital structures refer to the proportion of debt versus equity financing. Common size balance sheets can also highlight differences in companies' strategies. Comparing the asset composition of the companies, Company C has made a greater proportional investment in property, plants, and equipment, possibly because it manufactures more of its products in-house. The presence of goodwill on Company B's balance sheet signifies that it has made one or more acquisitions in the past. In contrast, the lack of goodwill on the balance sheet of Company A and Company C struggles that these two companies may have pursued a strategy of internal growth rather than growth by acquisition. Company A may be either a startup or a liquidation stage of operations, as evidenced by the composition of its balance sheet. It has relatively little inventory and no accounts payable. It either has not yet established trade credit, or it is in the process of paying off its obligations to its process of liquidation. Common size analysis of the balance sheet is particularly useful in the cross-sectional analysis, comparing companies to each other for a particular time period, or comparing a company with industry or sector data. The analyst could select individual peer companies for comparison, use industry data for published sources, or compile data for databases. When analyzing a company, many analysts prefer to select the peer companies for comparisons, or to compile their own industry statistics. Exhibit A presents common size balance sheet data compiled for the 10 sectors of the S&P 500 using 2008 data. The sector classification follows the S&P/MSCI Global Industrial Classification System, the GICS. The exhibit presents mean and median common size balance sheet data for those companies in the S&P 500 for which 2008 data was available for the Compustat database. Some interesting general observations can be made from these data. Okay. Balance sheet ratio. A ratio facilitates time series and cross-sectional analysis of a company's financial positions. Balance sheet ratios are those involving balance sheet items only. Each of the line items are on a variety of common size balance sheet. Is a ratio is that the expresses a balance sheet amount in relation to total assets. Other balance sheet ratios compare one balance sheet item to another. For example, the current ratio expense current assets in relation to current liabilities as an indicator of a company's liquidity. Balance sheet ratios include liquidity ratios and measures the company's ability to meet short-term obligations, as solvency ratios measure a company's ability to meet long-term and other obligations. These ratios and others are discussed in a later reading. Exhibit 19 summarizes the calculations and interpretations of selected balance sheet ratios. Cross-sectional financial ratio analysis can be limited by differences in accounting methods. In addition, lack of homogeneity of a company's operating activities can limit comparability for diversified companies operating in different industries. Using industry-specific ratios for different lines of business can provide better comparisons. Company disclose information on operating segments. The financial positions and performance of operating segments can be compared to the relevant industry. Ratio analysis requires a significant amount of judgment. One key area requiring judgment is the understanding the limitations of any ratios. The current ratio, for example, is only a rough measure of liquidity at a specific point in time. The ratio captures only the amount of current assets, but the components of the current assets differ significantly in their nearness to cash. Another limitation of the current ratio is the sensitivity to end-of-period financing and operating decisions that can potentially impact current assets and current liability amounts. After overall area requiring judgment is determining whether a ratio for a company is within a reasonable range of an industry. Yet another area requiring judgment is evaluating whether a ratio signifies a persistent condition or reflects only a temporary condition. Overall, evaluating specific ratios requires an examination of the entire operation of the company, its competitors, and external economic and industry settings in which it is operating. Summary: the balance sheet, also referred to as the statement of financial positions. discloses what an entity owns and what it owes, assets and liabilities. At the specific point in time, equities in the owner's residual interest in the assets in the company, net of the liabilities. The amount of equity is increased by income earned during the year, or by issuance of new equity. The amount of new equity is decreased by losses, by dividend payments, or by shares repurchases. An understanding of the balance sheet enables an analyst to evaluate the liquidity, solvency, and overall financial positions of a company. The balance sheet distinguishes between current and non-current assets and between current and non-current liabilities unless a presentation based on liquidity provides more relevant and reliable information. The concept of liquidity relates to a company's ability to pay for its near-term operating needs. With respect to a company overall, liquidity refers to availability of cash to pay the near-term needs. With respect to a particular asset or liability, liquidity refers to its nearness to cash. Some assets and liabilities are measured on the basis of fair value, and some are measured in historical costs. Note to financial statements provides information that is helpful in assessing the comparability of measurement bases across companies. Assets expected to be liquidated or used up within 1 year or the operating cycle of the business, whichever is greater, are classified as current assets. Assets are not expected to be liquidated or used up within each year or one operating cycle of the business, whichever is greater, are classified as non-current assets. Liabilities are expected to be settled or paid within a year or operating expense business cycle, whichever is greater, are classified as current liabilities. Liabilities are not expected to be settled or paid within 1 year or one operating cycle of the business, whichever is greater, are classified as non-current liabilities. Trade receivables, also referred to as account receivables, are amounts owned to a company by its customers for products and services already delivered. Receivables are reported net of the allowance of the doubtful account. Inventories and our physical capital that will eventually be sold to the company's customers, either in their current form, which are finished goods, or as input to manufacture a final product. Inventories are required at the lower of costs or net realizable value, and if the net realizable value of the company's inventory falls below its carrying amount, the company must write down the value of the inventory and record its expense. Inventory cost is based on specific identifications or estimated use. The first in, first out, or weighted average cost method, some accounting standards, including US GAAP but not IFRS, also allows last in, first out as an additional inventory evaluation method. Accounts payable, also called trade payables, are amounts that a business owns its vendors for purchases of goods and services. Deferred revenue arises when a company receives payments in advance of delivery of the good and service associated with the payment it received. Property, plants, and equipment, PPE, are tangible assets that are used in companies operating and expected to be used over more than one fiscal period. Example of tangible assets include lands, building equipment, machinery, furniture, natural resources such as minerals and petroleum resources. IFRS provides companies with the choice to report PPE using either a historical cost model or revaluation model. US GAAP permits only the historical cost model for reporting PPE. Depreciation is the process of recognizing the cost of long-lived assets over its useful life. Land is not depreciated. Under IFRS, property used to earn rental income or capital appreciation is considered to be investment property. IFRS provides companies with the choice to report investment property using either historical cost model or fair value model. Intangible assets refer to identifiable non-monetary assets. Let me drink my water. without physical substances. Examples include patents, license, and trademarks. For intangible assets, a company assesses whether the useful life is finite or indefinite. An intangible asset with a finite useful life is amortized and on a systematic basis over the best estimate of a useful life. With the amortization method and useful life estimates reviewed at least annually, impairment principles for an intangible asset with the finite useful life are the same as the PPE. An intangible asset with an indefinite useful life is amortized. Instead, it is tested for impairments of last annuity. For internationally generated intangible assets, IFRS requires that costs incurred during the research phase must be expensed. Costs incurred in development stage can be capitalized as intangible assets if certain criteria are met, including technological feasibility, the ability to use or sell the resulting asset, and the ability to complete the project. The most common asset that is not separately identified is goodwill, which arises in business combinations. Goodwill is not amortized. Instead, it is tested for impairments of least annuity. At least annually, financial instruments are contracts that give rise to both financial assets of one entity, of a financial liability or equity instrument of another entity. In general, there are two basic alternative ways that financial instruments are measured: fair value or amortized costs. For fair value instruments measured at fair value, there are two basic alternatives. How net changes in fair value are recognized as profit or loss in the income statement, or as other comprehensive income or loss which bypasses the income statement. Typical long-term financial liabilities include loans, i.e. borrowing from banks, and notes or bonds payable. Liabilities such as bonds issued by a company are usually reported at amortized cost on a balance sheet. Deferred tax liabilities arise from temporary timing differences between a company's income as reported for tax purposes and income as reported for financial statement purposes. 6 potential components that comprise the owner's equity section of the balance sheet includes contributed capital, preferred shares, treasury shares, retained earnings, accumulated other comprehensive incomes, and non-controlling interests. The statement of changes in equity reflects information about the increases or decreases in each component of the company's equity over a period. Vertical column size analysis of the basis sheet of the balance sheet involves stating each balance sheet item as a percentage of total assets. Balance sheet ratios are include liquidity ratios, measures the company's ability to meet short-term obligations, and solvency rates, measures the company's ability to meet long-run or long-term other obligations. Okay, so that's reading 24. I have finished reading 24. We are 1,500 pages in, and then, almost getting to the halfway mark. Okay, so we will continue reading 25, understanding cash flow statements, in our next reading, and I do hope my readings have been helpful, and I hope to see you guys in the next one. Good.